CNBC TV18 for all those updates. But let's discuss this and a lot more with Ajay Srivastava, CEO of Dimensions Corporate Fin Services, joining us now. Ajay, good morning. Thank you so much for joining in. Well, the street got what they expected in terms of CRR cut, but there's a slight revision in GDP growth forecast as well. What do you make of the commentary that came by? And is this something that means that February will see the cut finally in terms of rates?
I don't know what February will look like, but certainly for the savers, it's not a good year ending because there were kind of deposit rates they were getting. The banks will kind of put a halt on it for some time. It's not that 1 lakh crore is a very large sum of money for the system, but for the time being, it gives them ability to hold on to the deposit rate, which they're doing it. But I would still say that, when you try to, the failure of controlling inflation is hitting the economy everywhere. May not hit the stock market, and I'll tell you why. But the fact remains that you don't control inflation, and it's been a failure. It's been, 3 years now? We haven't been able to go below the 4% target rate, and RBI is saying they will not be able to do that till the next quarter of financial year. It tells you a story for the bottom segment of the population. It tells you a story of why consumption is slowing. It tells you a story about the fiscal impact of the tolls which the government are giving out to win elections, because the bottom strata of the society is really feeling the pinch. In stock market, one of the best part of stock market is we are kind of quote unquote unrelated to economy, because so many new companies are coming up in India, the newcomers, which are taking away business of Kirana stores, giving phenomenal returns to us. So many new pharma stories, so many new engineering stories are coming up. So stock market has its own logic, its own way of working. And to an extent, it's kind of an India dealing from the economics. So you had a situation of the growth rate going down and the market going up. Has happened many times in the past, will keep happening here. But bottom line is the fight for controlling inflation has been lost by the Central Bank of India. And I think today was a sad day, because I really respect the RBI governor. I really enjoyed all his commentary. Today was the first time I saw the body language down, the shoulders slouching and saying, you know what, I didn't win the war against inflation, and that's going to hurt us.
But maybe he'll have another term, Ajay. We're still getting clarity. We're still awaiting clarity on whether there is a term extension, and he was absolutely quiet on that front.
Well, he can't say, give me extension, can he? Absolutely. And I think it'll be rightfully perhaps to give him extension, but I always am a firm believer, new blood is always good in companies, in government, everywhere. So to that extent, if we have a new governor, maybe a new way to do it, because, you get tired of carrying the burden for some time, and that's time to put it on. He's done a good job. He's gone through COVID. He's done a fantastic job. Lost a fun battle, but kept the economy going. So I think on a whole, one would rate him as quite one of the finer governors RBI has had. But I think inflation is a weak point. And today, when you do the CRR cut, why would you do it? If you're fighting inflation, you want liquidity to be sucked out. So he's got a battle on liquidity. He's got a battle on dollars. You saw the steep 200 or 300 basis point increase in limits of FCNRB deposits up to March 25. That smells desperation for dollar deposits. That smells desperation. Not good for the rupee. Longer term, short term, today may be a blip. But the fact remains, I think we are now reaching a point where we need more dollars desperately. So I guess, for a stock market, a lot of mixed things. We're going to go back and analyze what it means for us. But bottom line, what it means for us is we don't want to buy into this market. We want to stay put with what we have invested in, keep some cash on the side. It's going to be tricky as we go down the path of lower and lower growth rates, as most of your economist panel was telling us that RBI, I think, overestimated the growth rate. So keep powder dry for the market. I think you will get chances to buy more, as you just saw 1 month back.
Actually, that was going to be my next question, Ajay, because a lot of economists are expecting downward revision to the growth forecast made by the RBI as well. And as you pointed out, there's a disconnect anyway between stock markets and how the economy is doing. So what are the reasons you think markets will continue to see a downtrend? Is it only inflation? Is it low growth rates? Or do you think generally the FI versus DI debate both will come at par someday, and we will continuously see those flows as well?
See, the problem with FI is that even for Indians, the US market is doing phenomenally well, and they keep doing well. And you saw what happened to crypto last night. Indian investors have not invested too much in crypto for RBI regulations, income tax, and not availability easily. But the ETF opening up, crypto ETF in the US, just changed the dynamics altogether for global investors. So I think Indian investors would weigh themselves more towards US market, will go towards crypto, will go towards gold, will go towards silver. I think that's one of the things which will keep them going for some time at this point of time. And number two for us is the most important thing is the budget is coming up on February 28th, which will give us a lot of pointers as to where the government's expenditure is going. Because our analysis team has analyzed that the way the dole policy goes on, it'll be almost impossible for government to do a major increase in capex budget and balance the fiscal deficit and still give out those helicopter money of 2,500, 1,000, 3,000, 4,000 per person that every government is announcing. And I just saw in Delhi they announced, AAP said 250 unit. People said, my God, they're giving freebies. Congress just came up and said, give 400 units free. It's a race to the bottom and this is where we see the problem to the economy, that how much money will go towards helicopter money and how much will really go towards generating good quality returns to capital. So we have to digest the results, we digest the budget. So that's why I said, keep powder dry. Where we are invested quite well, everybody's invested quite well. But Nifty 50, that's where the problem sits. Because those companies are heavily dependent on the economy and consumption at the lower end, and they are struggling to perform. So my guess remains that mid-cap will overperform and really do phenomenally well, including new companies, and Nifty 50 will struggle its existence. Some will do well, some will do bad, but Nifty 50 is a problem today in the economy.
Ajay, at the start of 2024, did you anticipate that Nifty would be up 13-15%, mid-caps would be up 27%? Did you expect this kind of a return? And what were your key learnings from the market and the trends that it's taught you for the way forward?
I think, our targets are much higher for our returns, of course. 13-15% doesn't bite us because might as well go buy debt or gold at the end of the day and then stop working. So, so this doesn't excite us. The inflation is 8.5% or 9%, depending what you want to buy. If you want to buy real estate, inflation is 100%. What you could buy last year for 5 crore is 10 crores today. So to that extent, Reema, having 13-15% expectation of return and being in the market doesn't make sense to anybody. You might as well put money in mutual fund and go home and sleep. But expectations are good. They have been met in large way. And I think one of the reasons they have been met is this huge surge of IPOs, and most IPOs have done well. So private placement market, both internal unlisted shares, has performed phenomenally well for investors. IPO has done extremely well. In fact, most companies have given really good returns. And the best part, the new economy companies, the larger ones, they have delivered returns. So, we were confident of what we were doing in the start of the year, keeping away from banks, keeping away from Bank Nifty and focusing on these companies. Few in Nifty, of course, like something like Trent or Indigo perhaps, but that's about it. But the fact remains that our mid-cap story continues to be strong, IPO story continues to be strong, and that is where the returns have come in this year. So no reason to be pessimistic. That's why I said, forget Nifty 50. That's for your grandfathers. You need to focus on the rest of the market. That's where the action is. Let somebody else go spend money on Nifty 50 companies. Maybe one or two good enough, and that's all about it. I was just calculating. You won't believe it. We have exactly 3 companies of Nifty 50 in our portfolio. That's all.
But why even ask grandfathers to invest in Nifty then, right? Everyone should make money if that's the case. But Ajay, thank you so much for joining in today with your thoughts on the markets. Well, that's some fundamental opinion coming in on the markets. And
for more news and updates, all you need to do is follow CNBC TV18 on all of our digital platforms.